Hello, I'm Kenneth Himmler Sr., and I am the CEO and founder of Integrated Asset Management, a wealth management and financial planning firm. And today we are going to talk about tax planning for Social Security. Now, depending upon what year you were born, you can ask for the Social Security estimate of what you will get. Most likely, it is somewhere between the ages for full retirement of 65 and 68 years old. Early retirement is considered at age 62. Now, one of the most important things to understand is that Social Security is not free from taxes. Unfortunately, a lot of people finally figure this out and finally understand that Social Security is actually triple taxed. That's right, it's taxed 3 times. Let me explain. When you are working, you are paying 7.65% in Social Security tax. Unfortunately, if you are self-employed, you are paying both of those sides, both the employer and the employee. Now, let's assume that you are paying those taxes. You do not currently get a tax deduction on the amount of tax you pay. That means that you would be paying the 7.65 to the Social Security Administration, but that's still included in your total taxable income. That means that currently you are paying taxes on the tax. That's double taxation. Thereafter, you will retire. You will get your Social Security. Depending upon the amount of income that you receive, I'll give you an estimate, between $33,000 and $43,000 a year. I'm rounding that. If you're married filing jointly and your income exceeds those limits, you would be paying taxes on 85% of your Social Security. That means you're paying taxes on the benefits you receive. So you've paid tax as a deduction from your paycheck, you pay taxes on those taxes, and then if you exceed those poverty levels, then you pay taxes on the benefits when you receive them again. Again, that's triple taxation on Social Security. Now, what will constitute that taxation? Again, if you exceed those limits, what are some of the things that you can do to prevent that? 1, keep in mind that tax-free interest from municipal bonds will count towards that income limitation. Again, currently I'm rounding it for $33,000 to $43,000 between those limits. If you're in between those limits, you'll pay taxes on 50% of your Social Security. If you exceed those limits, you'll pay taxes on 85% of your Social Security. But again, half of your Social Security will count towards that. Municipal bond interest, dividends, and any kind of capital gains will count towards that. Pensions, and the big one will be your mandatory withdrawals from your IRA. So depending upon if you're working with a competent financial planner that specializes with retirement planning, you might be able to shift or move assets into more preferential places that will remove those taxable items from your tax returns, thus possibly making your Social Security tax-free. Thank you for joining us. Again, my name is Kenneth Himmler Sr., CEO and founder of Integrated Asset Management.